in this particular cycle, we have not really had retail investors show up. So you don't see, for example, Google Trends searches for Bitcoin not doing particularly amazing. A lot of the demand this cycle has been on that more institutional side, which includes higher net worth retail investors as well, and including, of course, some retail investors. But it's not a very retail driven market like prior cycles generally have been. And that's in part because a lot of retail investors are strapped for cash at the moment. There's not a lot of them are financially struggling because we have an economic malaise. So one thing that does look pretty negative for asset prices, but an era we're in, is low consumer sentiment and business expectation sentiment. So a lot of the kind of the boots on the ground stuff is pointing toward weakness. And I would say the key reason for this is fiscal dominance, which is for the most part, if you had consumer sentiment this bad, it would look like a recession. So a lot of these other things would also be rolling over. But because we have fiscal dominance, we get an unusual separation from things like purchasing managers indices or consumer sentiment, these kind of real-time gauges of the economy, while asset prices can kind of levitate. And that's in large part because of fiscal deficits. And I think that's a structural thing that we're in now. And so you get kind of pockets of weakness and pockets of strength and just ebbs and flows along that kind of run it hot floor.